This is Rob Setigatpour from Stratco Property Group. Thank you for joining us this morning for the B6 Stratco Multifamily Market Update. We're here today with our guest, Matt Schatz from the B6 Debt Platform and my co-host, Mitch Flaherty from B6 Investment Sales. Today, we're going to be discussing the state of the investment sales market for New York City specific and an update on the related debt market and its impact on multifamily. So a few questions for Mitch today. Mitch, how are people doing property tours?
So hi Rob, thanks for having me. Good to be here. So that's an interesting question. Depends on the asset type. Obviously, development sites we're selling, you don't need to tour them. But for the multifamily sector, depends if the apartments are occupied or not. So with the vacant buildings or units, then it's okay to show our clients around, staying 6 feet apart. If the units are occupied and the client wants to get inside the unit, then maybe arranging a time where the tenant leaves the apartment for a certain slot and then we go in. And also we were doing a lot of virtual property tours. So it depends on the scenario. We're just trying to work our best through it.
So many of us have been thinking that there's probably going to be a decrease in pricing. There's going to be a glut to market. Where have we been seeing the state of the inventory on product to buy, and how has that impacted the cap rates?
Yeah, so in terms of pricing, I think it's too early to say. At the moment, there's a real lack of stock on the market. You wouldn't sell now unless you have to, and we're advising clients not to do so. I think there'll be a better telling in 60, 90 days when the forbearance agreements expire and you see more stock on the market. I think that the June regulation laws of last year had a bigger impact on pricing than COVID, where on average we saw a 30% decrease. We've seen cap rates, particularly in the Bronx, going from 5.5 cap to a 7 cap. So it's still early days. We'll have a better answer in 60 to 90 days.
Matt, what is that owner that has a retail component that's looking to possibly sell, or a buyer that's looking to underwrite a mixed-use building? What are they doing how are they underwriting that retail component, and what should they expect from the debt market?
Yeah, absolutely. So right now, I think it really varies depending on the type of retailer you have in your space. If you have a credit tenant like a Walgreens or a Duane Reade or a liquor store that's been able to be open during this pandemic, you probably have good collections, and the banks are underwriting it that way. If you have something more along the lines of a nail salon or a barber shop that's been closed and it's more mom and pop, they're taking a pretty drastic haircut to your pro forma income for 2020 in the future. I think that'll be the case really until we have a better handle on COVID and the potential vaccines, and we'll see how things go with the reopening. And I think that will sort of drive the underwriting for lenders in the future. But the best thing you could do is if collections haven't been great, be able to speak about what your business plan is, how you're working with your retailers to collect that rent, whether you're tacking it on or it's going to be a percentage rent. Being able to explain sort of your business plan will help ease some of the haircut to that underwriting.
So many operators, their exit plan or their recapitalization plan in the last 12 months has been their refinancing. With what's happened the last 3 to 4 months, what changes have we seen in rates, LTV, debt coverage? Are we still expecting the same proceeds we may have had 6 months ago?
Yeah, so to your last question, no. Proceeds have definitely gone down. The lone bright spot is rates are near historic lows. If you're talking about multifamily, that's in a top MSA, you are going to see very, very competitive pricing on both the agency front. You're talking sub 3.5%, as well as the banks who have historically been losing out on some deals to CMBS. They've gotten more competitive with their pricing as well to try and win back some of those relationships, and they're making up for it on the ancillary offerings that they have within the bank. LTV, you used to be able to borrow 75, 80%. I think right now, banks and other lending institutions are hovering around 60% LTV. We haven't really seen a change in DSCR. That's still at a 125 coverage ratio. And then, I think there's been a little bit more money held back for reserves as well as a debt service reserve. If you're talking about agency right now, it's at a year until you've maintained a 125 DSCR for 2 consecutive quarters thereafter. And then those funds will be released.
So, Mitch, we've been seeing, somewhat of like a slowdown and possibly a slamming of the brakes on the sales of, the old tenement buildings in New York City. Is there a certain product type that's still seeing a high volatility of demand or trades in the city?
Yes, I would say industrial buildings are very much in demand. We've seen little or no price adjustments on there so far, albeit the transactions that have happened were in contract prior to COVID. I think, these last mile distribution centers, Amazon just signed a 200,000 square foot lease in the Bronx. It's still very much in demand, and we see that trend continue forward. Just to add on to one of Matt's points, actually, I think the interest rates in the multifamily space are now relevant more than ever, given the fact that the buyers with the value add business plan had that opportunity taken away from them with the June laws last year. So you're actually collecting quite a healthy spread. If you're borrowing at 3.5% and you're getting a 7% cap, you've got like 250, 300 basis point spread. But there's certainly an appetite for buyers for industrial space as well.
So, Matt, you have the benefit of working across the country. With a lot of the, I guess, the specifics of what's happened in New York City, both a year ago and then the last 3 months with the peak of the COVID-19 cases. What have you been seeing nationwide, and what ends of the industry are you seeing that there's been no slowdown, or even more so the last 6 months there's been an uptick?
Yeah, so look, with June rent laws coming in and New York being one of the most difficult places to own and operate buildings in the country, I think that investors have had a search for yield outside of the boroughs, whether it be Jersey or other secondary and tertiary markets. That being said, I think those are the first markets to really get hit when something like a COVID or an economic slowdown happens. So I don't think that's going to be a forever move. I see it's more of a temporary move. That being said, I think there's been a flight again to multifamily, industrial, which are right now the 2 darling asset classes of the moment. Office, retail, and hospitality are really just not there for investor appetite. I think the yield has to be very compelling for someone to enter into a new acquisition of those assets right now.
So with the pandemic that came up a few months ago, a lot of owners and investors have been betting that there's going to be an increase in note sales. It could be premature, or it could be ripe right now. What's the crystal ball forecast from both of you, both from the investment sales and from the lending platform, as far as where you see that market, and how does an investor basically follow up with your office on seeing those opportunities?
Yeah, so from the lending side, I think we're a bit early in the cycle. When the pandemic first hit and there were some margin calls with some lenders, there was a disposition of some major sales, a couple $100 million off from Ladder. That's since slowed. I think that we're still in the forbearance stage. Banks don't really want to take back and foreclose on people's properties, not to mention that the courts haven't been open. That being said, I think if the pandemic stays out there for another 90, 180 days, we're going to start to see an uptick in note sales, and at a discount from par, which is where things have been trading right now in that 90 to 100 cent range. I think we'll start to see a discount there.
Yeah, just to add on to that, I think where you'll see some friction in the investment sales side is partnership disputes where, they lost their retail tenant, they're out of pocket every quarter in order to pay their debt coverage. I think you'll start to see some friction. It'll be a real test of the relationship, whether they can carry through the storm. But, you can reach out to me and Matt anytime. We're speaking to clients almost daily and trying to assist them with their capital needs going forward.
So at the end of this presentation, we'll be posting up everyone's contact info. Thank you very much, Matt, for joining us today for the state of the multifamily market. And Mitch and I will be back again next week with updates on other ends of the industry.
Thanks for having me, Rob.
Thanks, Rob.